Dave, good to see you again. Let's just start with your advice to investors right now.
Yeah, well, we're telling folks what we always do, that as uncomfortable as this period of time is, you really think long term. I'm not sure if this is going to last another month, another 6 months, another year. But I think for our clients, when we think 3, 5, 10 years out, this is an interesting entry point. And I don't know that it really, at the end of the day, is going to make that big of a deal. Where you are 10 years from now is to kind of whether or not you wait for a week or a month before you get started to invest. And you need to remain invested. It's, as most people would suggest, it's time in the market, not timing the market, that results in success ultimately.
What gives you the confidence that this won't be a period of chronic underperformance for stocks?
Well, I guess at the end of the day, we have some degree of confidence that the Federal Reserve will be able to manage their way up to an okay outcome. I think the Fed chair has kind of laid the groundwork for not optimal, but something that's not dramatically bad. And it's a very challenging time for them. I mean, if you think about what's going on, unwinding the quantitative easing with quantitative tightening to the level that we've had, we've only done this once before, and never at this size and scope. So it's clearly challenging for them to calibrate that at the right level of precision to nail down the perfectly smooth landing. But we don't need to get a perfectly smooth landing, I think, for our economic system to kind of prevail. And in the meantime, we look for companies that have the ability to manage their way through these kinds of environments and have done so in the past with some consistency. So looking for companies that can grow their top lines and manage the cost side and ultimately grow their earnings streams at a reasonable clip.
I wonder what you think of how consumer behavior is going to play out over the next, say, 6 months. We're going to hear from MasterCard's survey in a few minutes, Dave, and it's going to tell us that consumers are spending a lot, and they're spending on experiences, and their airline bookings are above 2019 pre-pandemic levels, and some other areas of expenditure are higher as well. But I wonder what is going to happen when consumers have that ultimate reckoning that they have, on the one hand, declining wealth. A lot of wealth has been destroyed here or transferred, and increasing prices. That is the anti-wealth effect. That is going to, I can't imagine that it isn't going to catch up with and dampen consumer behavior as we move into the summer and fall.
Tyler, you're spot on. And it's very, very murky to sort of suggest what's going to happen here. I mean, a lot of the data that we look at is backwards looking. And clearly there was some pent up demand, and we're seeing that in the statistics on the travel, on MasterCard's transaction activities and so forth. What we peered through in some of the earnings we've seen this week from some of the retailers, and it seems to be the lower end consumer is the one who's most challenged here. Even in TJ Maxx's,
as always.
Yeah, and this morning, even in TJ Maxx, if you read through the fine print, they said in their lower end demographics, it's a little more challenging than their higher end demographics. And so I think there's a tale of two stories here. On the wealth effect side, I think it's important to keep into context that, yes, this has been a challenging start to the year, but we're coming off 3 very strong years. So the wealth effect is, it's certainly a mental and psychological thing. But I think people, if they think back to where they were 2 or 3 years ago, they're still very much ahead of the game and have experienced returns that are well above long-term averages. So I think most people are still feeling pretty good, so long as this doesn't continue and persist for too awful long.